In this video, I'm going to talk about the economic profit for capital budgeting projects and analyzing capital budgeting projects using that metric. The economic profit is the profit that's earned above and beyond the required level of profit. So this is looking at perhaps a little bit more of an annualized basis. Perhaps you can look at essentially how much is being earned relative to what needs to be earned on a particular project. So calculate the economic profit. What you start with is NOPAT, net operating profit after tax. And then you subtract off a capital charge. The capital charge is basically linked to the idea that investors have put forth capital, and they are expecting a rate of return on that capital. And so the capital charge is basically saying, all right, if investors have put forth $1 million, they are expecting a 10% rate of return. 10% of $1 million is 100,000. So that 100,000 would be the capital charge, and I compare what is being earned to that. So if a project was earning 125,000, the capital charge is 100,000. The economic profit is the 25,000 in this example. So basically what we're looking at is relative to what's required in terms of earnings and profitability, basically, because earnings is a little bit of a slightly different concept here, but relative to what's required for return, what return is being generated by the project. And that's the idea behind the economic profit. And to add a little bit more detail to that, to find the net operating profit after tax, what you can do is you can also look at that operating cash flow. So by the time you get to operating cash flow, you have already factored in taxes and things like that. But then subtract off depreciation. So subtract out the depreciation at that point. And then you would take that and you would subtract from that basically that capital charge, so what's required. And the amount that's required is going to be the invested capital amount times the cost of the capital. And so again, if the investors have put forward $1 million, if the cost of the capital is 10%, 10% of $1 million is 100,000. Then I would take that, essentially that operating cash flow minus depreciation, subtract what was required, and basically find out, is the project generating more than is required? And what's important to note here is that this is economic profit. This is different from accounting profit. So for accounting profit, you could have a situation where a company made money, right? They made money. And in other words, like net income is positive kind of thing. So if we had a positive net income sort of scenario, that's like an accounting profit. That's not necessarily an economic profit. Let me give you an example of that. So let's suppose I am an investor and I invest in a company. I'm expecting a 10% rate of return. Let's say I had $1 million to invest. And if I invested it, let's say I'm expecting a 10% rate of return given the risks. So I'm expecting $100,000 of return. Well, if in an accounting sense, the firm generates a profit of, say, $75,000, the issue there is it's quite possible that with that $75,000 of net income, the issue that we could be facing is that might not actually, depending on whatever non-cash things we have going on, et cetera, it's quite possible that that is not producing the $100,000 of economic return I was requiring given the risk. So in other words, the investment is still making money in an accounting sense, but it is not actually economically profitable, and that is not generating enough return to compensate for the risks. So in this context with capital budgeting and economic profit, what we're looking at is not the raw profit, but we're looking at how much money they're making relative to what is required by investors to induce them to invest. And if you think about stock valuation models, this is actually conceptually very much related to the idea of the residual income model for stock valuation, where it's looking at what was earned relative to what was sort of required by the shareholders. So there's a link here between these concepts. It's the same basic idea. How much is being earned relative to what was required? Now, as far as decision rules go, it's pretty straightforward. If the economic profit is zero, then the project is generating more than was required to compensate for the risk, and so the project is attractive, and therefore we should accept it. If the economic profit is less than zero, the project is unattractive and should therefore be rejected. And if the economic profit is equal to zero, the project is neither attractive nor unattractive, and we are essentially indifferent about the project. All right, hopefully this video has been helpful. Hopefully it explains a few things about economic profit. Thank you so much for watching and have a great day.